together. Okay, so let's start with taxation of banking as promised. Yeah, that's our first topic, or sorry, that's our first chapter. Yes, it can also be our first topic as well. And under this, we shall be discussing the following subtopics. Are we together? Okay, if that should be the case, I know you are here with me all together, and we are going to do it together. Isn't it? Ajomasheni, that's it. Yeah, we are doing it together. Now, firstly, we are discussing sorry. Now, this is just like an examination guide. Okay, so you are expected to explain the concept of revenue recognition for BOFI and the various types of revenue, such as interest income, commission, sale of financial instrument, and financial intermediation, and also determine which of these streams of income would qualify as revenue and or other income under the relevant accounting standards, specifically the IFRS 15, and also explain the accounting treatment of hedging transactions and discuss its income tax implications, and also you have to define and explain the various financing arrangements and loan relationships engaged in by BOFI, including but not restricted to syndicated loans and sale and leaseback arrangements. And also you are expected to discuss the CIT exemption order for the exemption of short-term securities bonds, section 23 subsection 1 of Citn, that discusses about securities, okay, and their impact on the taxation of banks. Are we together? Okay, so also you have to differentiate between income earned in the ordinary course of business and income earned outside the ordinary course of business. That is sale of shares by a company and the sales of shares by a brokerage company. Are we together? And finally, you should be able to discuss at the end of this chapter contemporary issues such as the impact of Section 19 on banks whose major source of income is exempted from income tax, amongst others. Are we together? Okay, if that should be the case, now we start with concept of revenue recognition for banks. Yeah, I know you are here with me, and we are rolling in together. We roll together. Now, what do you understand by financial institution? Is it school of money or school? Because I know when we mention institution, what comes to our mind first is school, okay, maybe, or college, university. When we say institution, I'm going to higher institution, so that's it could be a university or a polytechnic or a college, okay. So I'm going to institute of so and so. Now in this case we have financial institution. What are they doing in there? Anyway, I would like to tell you that a financial institution is a company engaged in business of dealing with financial and monetary transactions such as deposits, loans, investments, and currency exchange. And it is not a school. It is what? It is a business. Are we there? Okay. And in that business, what are they doing? Are they selling money? Or are they buying money? Okay. Or are they printing money? Now, what they do is that they deal with financial and monetary transactions. Okay. Such as deposits. You go to bank, you put your money there. You put it as a savings, or you operate as a current account. Then you can also obtain loans to finance your business, loan for bank overdraft and the likes, and also investment purposes. Some also use the money, or they put the money in a fixed deposit, or in which what it earns them some interest. It earns them some interest income. Are we together? And also currency exchange. Yeah, your company, or you need to purchase some items from country other than Nigeria, which their currency is different from Nigeria. To say, for instance, you want to purchase an item from China, okay, And the trade policy is that what you purchase using their currency over there. Okay, here in Nigeria there's no way you could get what China currency. Okay, so the only thing you can do, or the best thing to do, or the best way of getting this yuan is to go to the bureau exchange, or you go to bank and you exchange your money. So legally you should go to bank. They are the financial institution. They are legally permitted. Okay, they are allowed to do that for you instead of going to a black market. Okay, instead of going through a black, sorry, that's my father tongue, or should I say my mother tongue? No. Yeah, back in class. Financial institutions encompass a broad range of business operations within the financial sector, including banks, trust companies, insurance companies, brokerage firms, and investment dealers. Are we together? Okay, so virtually everyone living in a developed economy has an ongoing, or at least periodic, need for the services of financial institutions. Yes or yes. If you do away without using the services of a financial institution, then it seems you are inviting those brothers, them, okay, those guys, okay, your friend, okay, those guys with this kind of what will I name that? Okay, I know you understand where I'm driving at. Okay, so in order to avoid any symptoms of robbery or the likes, okay, you should make use of what a financial institutions, even if it is a 10 naira you have at hand. Okay, so you should go and save it in bank to avoid being robbed altogether. So financial institutions can operate at several scales, from local community credit unions to international investment banks. Okay, so let's take the types of financial institutions in our area, in our great nation, and worldwide. Yeah, financial institutions offer a wide range of products and services for individual and commercial clients. Is that clear to you? To start with, we have our commercial banks, the likes of Zenith Bank, First Bank, Access. Okay, Damo, that has gone. We also have FCMB, we have Fidelity, we have UBA, we have Union Bank, we have Keystone Bank, and like, if I didn't mention your bank, please permit me for that, and next time I might. Okay, I'm not promising, because if I should promise you, and that's when Emmanuel will come. Oh, sorry, is that your name? I'm sorry. So that's when you will come and tell me, oh sir, you promised to mention my bank, but you didn't, and I can't, I don't want to be held liable for any words statements uttered by me. So now, a commercial bank is where most people do their banking, as opposed to an investment bank. Yes or yes? Yes. Isn't it? Yeah, correct. Okay, if I'm correct, I proceed. A commercial bank is a type of financial institutions that would accept deposits, offer checking account services, makes business, personal and mortgage loans, and offers basic financial products like certificates of deposits and savings accounts to individuals and small businesses. So banks and similar business entities such as thrifts or credit unions offer the most commonly recognized and frequently used financial services, such as checking, savings accounts, like I mentioned, or mortgages and other types of loans for retail and commercial customers. Is that clear? Okay. Now we also have investment banks. Investment banks. Or investment banks specialize in providing services designed to facilitate business operations such as capital expenditure financing and equity offerings, including initial public offerings. So they also commonly offer brokerage services. Brokerage, so let me write it down because I might not pronounce it as you are, okay, because of my father's tongue, okay, or maybe my mother's tongue. So now also we have our brokerage services for investors. They also act as market makers for trading exchanges, and they are also what a manager, or they manage mergers, acquisitions, and other corporate restructuring. Corporate what? Corporate restructuring. Are we together? Okay. So let's take insurance company. Insurance company are also what? Classified as other financial institutions. They are not banks, but they are other financial institutions. Are we together? So among the most familiar non-banking or non-bank financial institutions are insurance companies, providing insurance services, whether for individuals or corporations. It is one of the oldest financial services. Are we together? Yeah, if you agree that, so protection of assets and protection against financial risks secured through insurance products is an essential service that facilitates individual and corporate investment that fuel economic growth. Isn't it? Yes, I agree with you, sir. Thank you, my students. Now we have brokerage firms as well. Investment companies and brokerages such as mutual fund and exchange traded fund provide fidelity investments, specialize in providing investment services that include wealth management and financial advisory services. So they also provide access to investment products that may range from stocks and bonds all the way to lesser known alternative investments such as hedge funds, and private equity investment. Private equity investment. Are we together? Yes, sir. Thank you, great students. We are progressing, right? Okay. So also we have what? Sorry. Sorry. Just some minutes. Okay. So let's discuss various types of revenue business. Okay, various types of what? Various types of revenue. Various types of revenue. Are we together? So what are the various types of revenue? Various type of revenue for what? For BOFI. Various types of revenue for BOFI. I know you are seeing it on the screen. Nevertheless, I will take you through. Okay. So now we have our interest income. Interest income is the amount of interest that has been earned during a specific time period or during a specific period of time. These amounts can be compared to the investment balance to estimate the return on investment that a business is generating. In other words, the amount of interest may have been paid in cash, or it may have been accrued as having been earned but not yet paid. So in the latter case, that is, if it has been earned but not yet paid, interest income should only be recorded if receipt of cash is what is probable. If receipt of cash is probable and you can ascertain the amount of the payment to be received, okay, it is probable and you can ascertain the amount of the payment to be received. So interest income is earned from investment that pays interest, such as in a savings account of certificates of deposits. Okay, savings account of what? Of certificates of deposit. So it is not the same as a dividend, which is paid to the holders of a company's common stock or preferred stock holders, and which represent a distribution of the company's retained what? A distribution of the company's retained earnings. Okay, so let's take commission. Commission is what? Is the rather vague catch all term. Okay, and it is used by banks and other financial institutions to describe a set or range of fees for some of the services they provide. Okay, so basically they can charge for what they like. So that's commission. So it could be 5% on all services rendered, or 10%, or so it depends on the terms and conditions of the contract. Are we together? Okay, so in other words, a commission is a service charged accessed by a broker or investment advisor. By who? By a broker or investment advisor. Okay, so for what? For providing investment advice or handling purchases and sales of securities for who? For a client. So full service brokerages derive much of their profits from what? From charging commissions on clients' transactions. Okay, charging what? Charging commissions on clients' transactions. So commissions vary widely from brokerages to brokerage, so it depends on the terms of agreement, and each has its own schedule for various services. Okay, however, if the order is what? Okay, sorry, let's stop there. Okay, now sales of financial instruments. Okay, sales of financial instruments. Now as we all know that the money markets are what? Are wholesale market for dealing in what? For dealing in short-term lending, for dealing with short-term lending and borrowing, and for trading short-dated financial instruments. Are we together? Okay, so now also like I mentioned, that it is what? It's a wholesale market for dealing in short-term lending and borrowing, and for trading short-dated financial instruments. Okay, so wholesale markets are markets for what? Are markets for large value transactions. Okay, they are markets for what? For large value transactions. Why what? Why short dated, okay, or short term financial instrument are what? Are financial instruments that have what? That have 1 year, are we together, or less. Okay, they have what? They have 1 year or what? Or less to maturity when they are issued. So such include treasury bills of exchange, commercial paper, and the likes. Okay, so now we are moving. Okay, so the main money markets are what? The main money markets are the interbank markets, okay, and the repo markets. Okay, are we together? So there are international money markets for all the main currencies. Okay, for example, London is a major money market center which operates large money markets in the United States dollars, euros, yen, Swiss francs, and Canadian dollars, as well as sterling. Is that clear to you? And the purpose of this money market is what? Is to provide short-term liquidity to entities needing money specifically when you want to trade with companies abroad. Okay, so you are a multinational company sorry. So also another purpose of this money market is to what? Is to create opportunities, to open opportunities for entities with surplus liquidity. Are we together? Okay, so we've taken this, right? So what are the purpose of the money market? I've mentioned this as well. So that is to what is to provide short-term liquidity to entities needing money, and to what? It opens opportunities for entities with surplus or to surplus liquidity. Okay, so banks are the most active participants in the money market, but some large companies also have direct access to the market. Smaller companies and individuals might be offered an opportunity by their bank to borrow or lend at money market interest rates, and their access to the money market is what is made through the bank. Okay, so this means that companies are able to borrow or deposit money short term in the money market through their bank, and when they participate, mind you, through their bank, they can borrow or lend much smaller amounts of money than the normal size of money market transactions. Are we together? So money market also provide ready access to short-term borrowing and lending opportunities in foreign currency other than local currency. Are we together? So let's take the interbank market. The interbank market is a market for borrowing and lending large amounts of money for a short term, often overnight for one day, but possibly up to 1 year. Are we together? So as the name of the market indicates, the interbank market, it is mainly a market for borrowing or lending between banks, but as explained earlier, companies are able to participate directly or through their bank. So when they participate through their bank, they can borrow or lend much smaller quantities of money. So interest rates in the interbank market vary according to the duration of the loan and the credit rating or credit status of the borrowing bank. Okay, of the borrowing bank. So banks with a very high credit rating are able to borrow at lower rates than banks with a lower credit rating. Okay, so the interest rate charged to top quality banks are therefore monitored. For instance, in London, a number of banks report that their borrowings rates to the British Bankers Association (BBA) each day, and the British Bankers Associations (BBA) British Bankers Association uses this rate to determine the average borrowings rate for top rated banks. Now let's take the repo market. I know when I mentioned repo market the other time, I know you as a student will be conscious that what's the meaning of repo, and this guy didn't explain it in detail. Now here we are. A repo is a sale and repurchases transaction. It is a what? Sale and repurchases transaction. Repo repurchases what? Transaction. Sales and repurchases transaction. And in repo, in repo transaction, one party sells a quantity of short-dated bonds or money market securities to the other party, and at the same time undertakes to buy them back at a specified future date at a higher price. So it's just like a form of borrowing. Okay, of borrowing. So it's just that you give what you have to get what you don't have. Is that clear? You give what you have to get what you don't have. So then in the future dates, you pay back what you don't have, you get with what you have, then you also get back what you exchange for what you don't have in a later date in the future. Is that clear to you? Yes, sir. Now if that is clear, we are good to go. For example, a bank, let's say bank A might arrange a repo transaction with bank B, in which bank A sells a quantity of short-dated government bonds and money market instruments to bank B for say $20. Or do you want me to use million? You want to use naira because Nigeria is our great country. For $20 million, $20 million naira, and agrees to buy them back after 14 days for what? for 22 million naira. Wow, that's nice. 2 million naira within 14 days. How much salary do you want to pay me? Should I come? So you can see this is very quite paying. Okay, so within 14 days I have 2 million extra. Please, I am in repo market, come and invest in me. Now back to class. So in effect, a repo transaction is a short-term secured loan. It's a short-term secured loan. So now let's take financial intermediaries. Who are the financial intermediaries between individuals, companies, and the likes of government? Now financial intermediaries uh, includes companies, governments, and individual. Okay, companies, governments, and individual needs money. They need to raise money, and these providers of finance are what? They are also individuals, companies, and other organizations with surplus funds to invest. Borrowers of finance include what? Includes companies, governments, and individuals that needs to raise money. And providers of finance are what? Are also individuals, companies, and other organizations with surplus funds to invest. They don't know what to use the money for, and they are looking out for companies, individuals that could make use of this money effectively and efficiently, and that also allows them some returns or some interest. Okay, so now although it is possible for borrowers to obtain funding directly from an investor, it is usual for borrowers and investors or lenders to be brought together by financial intermediaries in the financial market. So therefore, a financial intermediary is a person or organization that operates between savers. Who are the savers? They are what? Investors, because they don't know what to do with their money. It is assets in their hands. Okay, and also borrowers. So they connect what? Both the savers, that is the investors, and what? And the borrowers. They connect them together. So they know the individuals or companies with surplus funds, and also they know companies or individuals or government that are in need of money. They need to raise some capital. They need to raise money to finance their projects. Isn't it? Yes, it is. Thank you, my students. We are together. So their role is to redirect the funds of savers and investors to the individuals and organizations that need to obtain finance. Is that clear to you? Yes, sir. Now let's take banks as financial intermediaries, or are they not? Yes, they are. Yes, thank you, my great student. We are together. So it is pertinent to know that without financial intermediaries, it would be difficult for businesses to find individuals willing to provide all the money they need. Even when they find the individuals willing to provide all the money they need, you as an individual, would you? No, sir. Why? Because we are Nigerians. They can go away with my money. Okay? No, they won't go away with your money. You know their house now. Oh, Nigerian guys. Even when you know their house, more they escalate. Now, we are together, okay? So, without these financial intermediaries, the savers, that is the investors, will not, because they don't trust the integrity. They have no confidence in other individuals, especially the borrowers, or the individual borrowers, companies, even the governments. Okay, so let someone be our intermediary. So in the case of any default on your side, it is this intermediary by fire by force. you know in that case now. So because I have entrusted my funds in your so in your purse, okay, and it is now left to you how to use it, where to use it, whom to loan or borrow, and the likes. Okay, so that's just that. Are we together? So without these financial intermediaries, it will be difficult for businesses to find individuals willing to provide all the money they need for the length of time that they need it and at a cost they are willing to pay. So these financial intermediaries will have negotiated everything, finish everything. You just come to them and they, okay. So now let's take banks as the financial intermediaries. As we all know that they are financial intermediaries and they take deposits from customers and lend this money to other customers in the form of bank loans and bank overdrafts. Are we together? Okay. So if a company needs to borrow, it can go to a bank, the intermediary, instead of having to find an individual or organization with spare funds for lending. So banks are important financial intermediaries because they are a major source of debt finance for many companies and individuals. Yes or yes. So they also create new credits. So the roles of banks in credit creation is unique, isn't it? Yes. Thank you today, my students. You are good. We are going together. We are doing it together at German Training. Now, thank you. So, in performing an intermediary role, banks perform several functions, isn't it? Yes. Now, let me take it this way. Suppose that bank receive new customer deposit of what? Let's say 1 million naira. I like to use my currency because I am in Nigeria. So now the banks can lend this 1 million naira, but will hold some in the form of cash or near cash investment to cover the possibility that some of the deposits will be withdrawn. Okay, so in this case they might decide to lend out what? To lend out 500,000. Are you from Ibadan? Yes, sir. 1,000. So they might decide to lend out what? 500,000, and we still have 500,000. So that should, in case the owner, that is the saver, want to withdraw. So that's what they do. You can imagine the number of individuals that will come and save, or what do they save? Money. Okay, thank you. So imagine I come to save 1 million and you come as well to save 2. The other guy came to save 1.5 and the likes. So this is how they do. They turn it over. And when you come back, you want to do sorry, that's the ATM. This machine is out of service. I am out of service, or I'm undergoing all sorts of English or grammar, So now, out of service, out of cash, whatever. Now, in performing an intermediary role, we are back in class. Okay, so okay. Also, mind you, when banks lend money, this money becomes new customer bank deposit. In other words, by lending money, banks create more bank deposits which can be lent. So the new money that is lent becomes more new bank deposits which can also be lent. Is that clear? Okay, so the role of banks in in performing an intermediary role, banks perform several functions. One is that they are able to access funds deposits from customers and lend in much larger amounts to borrowers with their interest. So banks also provide maturity transformation, and banks also provide risk transformation for who? For saver. For who? For saver. So we are progressing, right? So banks are they are an important source of finance for all types of business and all sizes of businesses. All size of business. So in the case of small businesses, bank loans and overdrafts and possibly lease finance are the only readily available source of borrowed capital. We are going on break right now, and when we come back, we continue from where we stop, and we are taking other financial intermediaries. Thank you for being together. Thank you for your active participation in class, and have a lovely break. And goodbye.